Welcome to our weekly Ask the Fund Manager series. The premise is simple. We put a fund manager on the spot and we ask them questions about current events and how these events impact on investment markets. We aim to keep it interesting and understandable and do this all in under 5 minutes. We hope you enjoy.
Sotirios, I think I might need to go to Specsavers because I'm looking at a Bloomberg terminal and equity markets, for some reason, are all-time highs, which doesn't really make sense when you think about all that's going on in the Middle East. You're looking at oil prices being much higher, and of course, inflation creeping back into the system and into headlines, news headlines again. So all those things don't exactly scream all-time highs. So I've got a very simple question for you, which is, have investors just lost touch with reality, or are they kind of looking through that noise?
I know it does look counterintuitive at first, making new all-time highs while all that news flow feels still quite negative. But I would argue that investors are not completely discounting the risks here. All they're doing is they're filtering them and asking one simple question. Does this shock genuinely change my long-term economic growth outlook or the company profit outlook? And the answer the markets are giving so far, particularly in the equity space, is not enough. A lot of bad news, of course, geopolitics, oil prices, inflation worries. All those indicate so far a severe shock, but not a structural break. And for long-term investors that can take a bit of a longer horizon, that distinction is really what matters. And they try to avoid every headline similar to what we do, and instead focus on what actually changes the medium-term outlook.
Okay, so looking through the noise, there's a shock that's happened to the system with what's happened in the Middle East, but the markets are saying that's not going to be something that's going to hurt the markets for a long period of time. So they're kind of looking through that noise. That makes a lot of sense. But, it's been a bit of a rough ride this year for markets. They took a wobble earlier this year. Equity markets sold off quite sharply. But from the lowest point earlier this year, towards the end of March, equities are now up over 10% and at all-time highs. So that's quite a quick turnaround. So what changed? What sparked that turnaround?
Well, the big turning point was, of course, a step back from the worst-case scenarios. So when tensions were at their peak, markets were fearing for a prolonged disruption of energy flows. And as a result, we had quite very high elevated oil prices, interest rates, volatility, and risk assets selling off. But the moment the market started to sniff that there is a path towards resolution, and particularly the reopening of the strait, that's the most important factor for the investors, those extreme outcomes were dialed back almost mechanically. So people were starting to unwind insurance that they were buying during this event. So as a result, energy prices fell, not back, of course, to where they were previously, because there's still a risk around this. Volatility in interest rates has dropped, and overall, the investors started to become a bit more constructive. The other factor I would argue has been quite important is that the earnings forecasts have not really been downgraded yet. We have seen quite the opposite, actually. We have seen some upgrades in the tech space, as well as, of course, as one would expect, upgrades in the oil equities. Given we're looking at higher oil, more elevated oil prices structurally from here. But so far, we haven't seen earnings downgrades. So if you get the left tail being removed, as you mentioned, and then you get the constructive earnings outlook remaining, then that was quite a compelling case for investors to actually buy back equities during this recovery period.
So we've talked a lot about equities, but it's not just an equity story. And the reality is, like, a lot of investors will hold lots of different asset classes, a diverse portfolio, and another big asset class is bonds. So have bonds, like equities, sort of had a quick turnaround and have their prices sort of go back up as well?
They have to a degree, but they haven't really recouped the losses they had during since the start of the war, which is what equities have done essentially. I think it's more important for the bond markets what's going to happen with inflation. And the jury's still out. We don't know how persistent this shock is and what the reaction function of the central banks will be. I think it's quite important that the inflation expectations remain anchored. And if that's the case, then maybe central banks are able to look through the event, similar to what the equity investors have done, probably. But so far, I think it's still an unanswered questions. We'll collate, of course, more data points as time goes by, but so far, bond investors are still worried. And then a simple example is if you look at the market's expectations for ECB, we're still looking at 2 hikes before the end of the year.
Okay, so everything we've discussed now is sort of like the past. This is all assigned to the history books, but what we've seen recently in this year is the sentiment has jumped from being more positive, which it is now, but also been negative, and it's jumped from positive to negative a few times really during the year. So if you're trying to plot a course from here, what should investors really be watching to try and get a good idea of whether we could expect more optimism or a revert back to more volatility?
As you say, there is a path of escalation to de-escalation and so on that's quite difficult for investors to navigate. I would argue there are 3 things that investors should closely look. The first one is, of course, the Strait of Hormuz and how many vessels are flowing. I think that's the most important part because we have been approaching points that the supply constraints can be quite material. So we need to start to see energy flow quite soon. The second one is the company earnings. We need to see that profit outlook I mentioned to remain resilient. If margins come under pressure, for example, particularly outside tech, that could test confidence across certain sectors. And finally, as I mentioned, the central banks. It's very important to see how the central banks will react to this, because if they get into a situation where they prioritize growth, for example, they might cut interest rates. If they get into a situation where they're prioritizing inflation and price stability, they might increase interest rates. And of course, there's a big difference between those 2 outcomes, but they're both reasonable and reasonably possible. So from that point of view, those are the 3 factors I would say investors are mostly focused right now.
Okay, so a key takeaway as we wrap up: the investors haven't lost touch with reality. They're looking through the noise, but they're not ignoring the noise. They're still very closely watching what's happening, and depending on how the events unfold could mean there's a change in sentiment again. But so far, there's been a bit more of a return to more positivity and a de-escalation. Sotirios, we'll leave it there. Thanks so much for your time. And of course, we'll be back again next week with another topic that's caught our eye.
Thank you for listening. We hope you enjoyed this episode, and we hope you listen in again next week. Also, we love to get feedback and ideas for future episodes. You can use the link provided below to share your thoughts. Before you go, just some important information to be aware of. Unless otherwise stated, any opinions expressed are those of Aviva Investors. You should not be viewing this as an indication of any guarantee of return from an investment managed by Aviva Investors, nor as personal advice of any nature. Information contained herein has been obtained from sources believed to be reliable, but have not been independently verified by Aviva Investors and is not guaranteed to be accurate. Past performance is not a guide to the future. This material is not a recommendation to sell or purchase any investment. The value of any investment and any income from it may go up as well as down, and the investor may not get back the original amount invested. Nothing in this material, including any reference to specific securities, asset classes, and financial markets, is intended to or should be considered as advice or recommendations of any nature.